Yeah, tactically, I would say this, Scott, and it's great to see you back, man. It really is. I got to tell you, this is an unbelievable trading environment. Is it a stock trading environment or investing environment? I think that's really difficult. It's hard to call the bottom. I mean, the velocity of the moves that we have had, Scott, just go back, and you said Thursday, Friday. Forget Thursday. The last 2 hours of Thursday and Friday was a 1,500-point move in the Dow. So, I mean, what does that tell you? It tells you these are crazy times. It tells you that we have incredible velocity within the market. We see volatility spiking up to 38. It can't hold at all. And then before you know it, it's back underneath 30. So with all those indicators that are out there right now, it's telling me great trading environment. I looked and looked and looked. I could not find stocks that I wanted to necessarily buy. Now, I will say this as well. When I say trading environment, how about this? On Friday, we had Cleveland Cliffs. I know that's a huge name that Jimmy has loved and talked about for a long time. He's been right. I didn't choose to buy the stock when I had options that were getting bought in there, Scott. They bought 10,000 of the May 23 calls for a little over $1. Now, that stock has moved up today. It's up about 10%. Jimmy's pretty happy. Those calls went from $1 to almost $2.50. So that's, what is that? 100%. Not so bad. So that's why I say this is a trading environment. And I think you've got to look at it that way because we don't know from day to day what direction these markets are going. We started off today with the Dow down 500 points, and now we're off just a little over 100 points. We had the NASDAQ in negative territory by 100. It's taken off to the upside. These are all very great things if you're trading the markets. Not so great for investing because we know how fast they can flip that final hour of the day, the last 2 hours of the day. That's when the trading really begins, and we start to see the huge volumes start to come into trading as well. So I think it's a very difficult time to be saying, you know what, I think this is the bottom. I still look to Mike Wilson and say, you know what? He's becoming more right all the time for Morgan Stanley. And a lot of people that were very critical of him are now starting to see that he's actually been pretty daggone accurate.
Okay, since you brought up Mike Wilson, I'm going to go there now. And Brenda, I want your reaction to what Mike Wilson is saying today, which is essentially a double down of, or I don't know, at this point, it's like a quadruple down of the point he's been making for as long as I can remember at this point, talking about what he says are knowns and unknowns. He calls last week's tactical rally in equities, saying it will likely run out of momentum in March as the Fed begins to tighten in earnest and the earnings picture deteriorates. He says valuation remains extended. Evidence is now building that earnings forecasts are increasingly at risk. Now, talking about the momentum that we're starting to see in negative earnings revisions, and he's not the only one who's suggesting this either, by the way. Liz Ann Saunders of Charles Schwab was on the network within the last couple of hours suggesting the same thing, that it's something to keep an eye on, that is going in the wrong direction, these negative earnings revisions. And for all of those who suggest that at the end of the day, the strength in corporate earnings and the strength in growth is going to be able to offset whatever the Fed does and whatever other variables you throw at the market, you're going to hang your hat on the fact that earnings are going to remain strong. Well, maybe not so much. What do you think?
Well, I think earnings growth is really the key to the market recovering and the market delivering a positive return this year. So I think that's an important thing to keep an eye on. But I think if we look at the reasons why we have seen some negative revisions, it's still because we're in this period of uncertainty in terms of the Omicron impact. Supply chains are still a disaster. So a lot of these things are contributing to uncertainty for companies when they're giving guidance, forward guidance. So I think to the extent that as the year goes on and we do get more clarity there, if supply chains begin to unwind a little bit, and if consumers shift their spending patterns, as we think they will, towards more travel, leisure, services-related spending, that should help alleviate things. So we think that over the longer term, and I'll just echo some of the previous comments, but as Shannon mentioned, looking out 12 months from typical geopolitical events, usually the market is higher. And so we still think we're in a strong environment. I'm not saying I think the bottom has been made in the market. I still think there's uncertainty here. But for longer term investors, I think maintaining diversification is really important. It's been a good lesson this year, especially if we've seen these wild swings between market leadership, particularly in the last couple of weeks. So I think staying diversified and staying the course is really important.